Hello and welcome once again to the Smart Money Dumb Money Show, and I am your host, as usual, Keith Richards. I'm President and Chief Portfolio Manager at Value Trend Wealth Management, and today with us is Craig Aucoin, who is Vice President and also Portfolio Manager at Value Trend. Craig, welcome back.
Hi, everybody. Thanks, Keith.
So we're going to cover the Ask Us Anything questions, answers. How's that for a mouthful? We did a Ask Us Anything blog a couple of weeks ago, and we had quite a few replies. So we've got a lot of questions to cover between us. So we're going to try to sort of go through them with some degree of thoroughness, but at the same time, we want to get through all the questions. So hopefully we will meet those goals of being thorough yet quick. And with no further ado, I'm going to start with the first question, because that's what you guys are here for. So you'll see me once in a while, as well as Craig, look down, because we have our question cheat sheets in front of us, and I don't have them all memorized, so I do have to look down every once in a while. So we're going to start off with Brian's question first, and these are in no particular order. Brian's name just happened to appear first on the question list. So Brian asks us about the insurance industry. He gave 3 specific Canadian names. So I'm going to start with Craig. Craig can give us the fundamentals. He's the CFA, as you guys know, a chartered financial analyst. So he's the fundamental guy in the operation, and he's going to give us the backdrop on what he sees in the industry. Take it away, Craig.
Hi. Thanks, Keith. All right. So insurance companies in Canada right now, specifically the life insurance, Manulife, Sun Life, Great West, they're seeing decent flows into their business, so that the reporting the results recently have been okay. The real element that has changed for insurance companies is the yields that they're getting on their surplus assets. So in the past, those liabilities on an insurance company's balance sheet, they haven't really been getting paid on them. The yields have been so low that they've really been forced to accept those lower yields. So that's improved for their short term, their cash, they're getting more return on those. So that's a positive, and it's really benefited them. The one area of concern or question that I would be the longer term liabilities on their balance sheet. They've had to take some bonds in the past that they've been forced to take lower yields. So those bonds have certainly lost value. So while the insurance companies may be able to hold them until they mature, which is fine, if they are forced ever to sell, they're going to recognize, and they are sitting on some larger losses there that they have to massage. They have to just be careful whether or not they have to. They wouldn't want to recognize those is what I would say. But the business themselves, this is an environment where I think the insurance going forward is pretty stable and pretty able to do quite well.
Okay, well, yeah, that's a good point. It's and the way we're looking at the insurance companies are more as good old-fashioned dividend payers that are reliable. So the charts, and I'm going to share screen, and we'll go right to. There's a couple of different charting software I'll be using today, but I just wanted to look at. This is one that I use regularly. It's quick and easy charts rather than stock charts. It's right on my desktop all the time. It's with FactSet, and what you can see here is this is Manulife, so it's a weekly chart, and you can see I can hold my cursor here, and there's a bit of a lid. Now like Craig said, it's a stable sector. So, I mean, it did fall out of bed in 08, but since then it's really been very choppy sideways, which isn't so bad for a buy and hold investor that just wants the dividends. Now, for capital gains type of people, if you try to buy it near the bottom of the range, which seemed to be maybe around $20, it might be a good play to the upside. At this point, you're closer to that top of the range. So you'd find that with Manulife and SLF, which is Sun Life. The one you wouldn't probably find that with a little bit is Great West. So I'm going to pull up that chart, and you can see it's trying to break out. So for as far as capital gains go, I'm just going to rip this over a little closer. You can see it's attempting to break out. It's done this before though, about a year or so ago, and it failed. So right at this exact point. So I'm not going to count on Great West breaking out, but out of the three that Brian mentions, this might be the better of the three. Either way, I think for capital gains, it's a higher risk trade, but for long-term dividend oriented investors, it's fine. So that's all I'll cover on that. The next question is from Mark, and I really don't need a chart for this. I could have pulled up a chart, but I can explain this fairly straightforward. Mark asked if we use the Commodity Futures Trading Commission's COT report, and that stands for Commitment of Traders. And I mean, it's a lot of people use that for commodities. So he's wondering if I, as a technical person, use that report, and the answer is no. A commitment of traders is basically looking at the three types of traders. So there's the big hedgers, right? So if you're Barrick Gold, you will hedge the price of gold through commodities contracts because you're trying to sell the stuff and you don't want the price to slap you upside the head if it goes down after you've mined some. So you can be a commercial hedger and hedge your product. You can be a large speculator. Now I should say, and speculator is the word they use within commodities. It really doesn't necessarily mean it's a speculation. And I'm going to give it a good example here. Let's take OMERS or Teachers Pension Plan, two of the largest pension plans in Canada. I wouldn't necessarily call them speculators. They're not like these hedge fund managers that you think of, but they do sometimes take on positions to protect their portfolios as well. So they'll have huge positions in equity indexes, for example. So they may do a futures contract to offset the risk if they feel the risk is high, without having to sell their positions and raise capital gains or risk being wrong by selling. So that's the large speculators, and then there's the small speculators, and that's who you think are the speculators. So they're usually referred to by guys like me who do sentiment stuff as dumb money. So small investors are usually wrong, and the big people are usually right. So why don't I follow these three groups? Because I don't have to, because I subscribe to Sentiment Trader, and they have these optics, so I can look up oil, and the optics includes the Commitment of Trader reports as well as a bunch of other stuff. So Commitment Traders is really just a sentiment indicator. It's a good one, but it's not the only one. So I just give them all in one bundle if I want. I could look at them separately, but I don't. So hopefully that helps. Next question is from Mike, and you can see we are kind of slamming through these because we need to. Mike asks where I see XLE, which is the US oil energy producers ETF, or XEG, which is the one in Canada, both run by iShares. Where would I find a decent entry point? And he also asks about uranium. See, I let him get away with two questions, and I said you're not supposed to ask two questions. So I'm just going to answer them really quick. Just go back to the screen share. So let's take a look at. First of all, XLE has been around a little bit longer, so I will just take a look at this. Now, I'm also going to illustrate something that I made a comment on just the other day, and that is that the US producers right now look better, and we will talk a little bit about that in a second. But if we kind of pull the chart over, you can see the producers are at a bit of a lid. Okay, so if I draw that line, you can see that there is some resistance here. And just for the record, Craig and I recently took some off the table. We did not eliminate our position in the energy stocks, but we took some off the table with 2 positions that we had decent sized positions in. We cut them in half. So we still have a position in oil, but we reduced them because we're at a lid that's proven to offer a fair amount of resistance. Now keep this chart in mind because you'll see how the energy sector's done in the US. And if we compare that to XEG on Toronto, which is the Canadian index, and you can see that it's nowhere near the old, like, so the highs, you saw the highs on the XLE, well, the energy sector in the Canadian market is not at its old highs. So the entry position is to get back to Mike's question, I would buy on a breakout actually. Now, and that same goes with this. You can see that in the near term anyways, that XEG is also seeing some resistance, and you know, you needed to break that lid. Now, again, we sold, and so far we seem to be okay on the trade. But you know, this is a short-term view for us that we think it will go through. But I gotta say, I'm a little bit more intrigued by the US lately. And that's, you know, if you read the blog that I just wrote called Lots to Talk About Today or something, I just did it a few blogs ago, and you'll see that there was a comment by, and man, I can barely say this guy's last name, but Rafi Tasmasian, that's how you say his last name. But he's the CFO for Canoe Financial, and he basically said that, you know, Canada is doing it all wrong. We are giving the Canadian government, meaning the Trudeau government, and you probably see the sign in the background, you know where I stand politically. I think anybody that reads my blogs does. They have been actually disincentivizing development in oil and gas. And there's a problem with that because we need it, and we need it for the next many years. But the problem is that as they disincentivize oil and gas production in Canada, it puts pressure on the producers. You know, as to put it in his words, not mine, the Trudeau is moronically stupid. But hey, that's not me saying it. So just case in point, you can see the underperformance of those Canadian energy stocks. Okay, so let's just keep that in mind, that the US stocks have, it's not all clear for them either, but it's certainly a less blocked road. Not that it's a completely unblocked road for them. Either case, though, they're both under pressure by you know, the whole green movement governments, right or wrong. And you know, I think that they need a reason and a catalyst to break out past those resistance points. Let's hope we see it, and that could be Saudi Arabia's oil thing. I think I mentioned it on an oil video recently. So we'll go to the next question, also for me, and then we'll get one with Craig in a second. But the next question, I'll take it off your share screen. The next question is Francisco, and this is a quick and easy one. He said, I did a global video on global ETFs, and you can look that up on the videos. And basically, he said, you looked at the EWD chart, which is Switzerland, and you said it's a trading range stock, and he felt that it might have been in a little bit more of a downtrend. And so I want to just share the screen and show the chart of the EWD, and you can see why I'm saying it's a trading range chart. Okay, so I do see Francisco, sorry, EWD, sorry, here's my dyslexia, EWD, US, and there's Sweden, not Switzerland. And so you can see, here's the chart. If we look at the range, that, yes, I can see where Francisco's thinking it's in a downtrend, but really it's more from a very giant peak that it had in 22. But if you look at the longer term range, and technical analysis looks, when we're trying to pick resistance and we're trying to pick support, we look for the most touches, as it's called, like the most times the price reached a certain level and failed or found support. And you can't call the 21 peak as a multiple time. I mean, it was hit a few times during that year, but the bigger picture is that there's been a lid of somewhere, I'm gonna call it around $37.50. Okay, so there we are again. It's range bound. It's right. It just came off of the top. No surprise. I mean, look at how many times since 2011. I mean, that's like 12 years. It has failed at 36.5. So this lid is very, very relevant. And this support level, look at how precise this is. This support level is around 26. Okay, so this is what I was talking about, Francisco, is that, you know, you're trading the most likely scenario. It's not actually in a downtrend on the very big picture. It's in a very contained sideways range, 26-ish to 36-ish, call it. Okay, I like using that word ish because none of these points are precise. So I hope that answers your question. I don't see a downtrend. I see a very tradable range. So the next question is for Craig, and it's from Joanne. Take it away, Craig.
So Joanne asked, she asked about the future for marijuana stocks. This is a sector that certainly has lost its luster in the last number of years. The valuations were, you know, extremely stretched, and they've collapsed. So the future for them really hangs on US legislation, and the focus is how that can impact these stocks in the future. There was a bill that went through the Senate earlier this week that is it's in the right direction. It has to do with the financing of the marijuana companies and how financial institutions can hold some of their cash and assets. But the company specific, they struggle with, you know, being profitable. For instance, you know, Canopy Growth is one that, you know, has made headways, and that they've really tried to legitimize themselves, diversify into other parts of business, but now they're going back to focusing just on the marijuana itself. Recently, they came to market to do an issue. They had to attach warrants to some of that issue. Well, it's not generally thought of as, you know, a great prognosis when you have to attach warrants to an issue. Warrants are like a sweetener. It's, you do this for me and I'll give you this too. Well, the warrants are exercisable 5 years, not too far different from where the price is now. All to say, they've got some headwinds. Marijuana stocks companies have some headwinds ahead of them, and it's not smooth sailing now. In that, sure, you can, you might be able to trade it because there are some catalysts, but as far as longer term, they do have some headwinds ahead of them. I don't know, Keith, if you wanted to take a look at one of the stocks, technically the Horizons Life Science.
You know the ticker, Craig?
Yeah, it's HMLSF.
So we'll just do the quick and dirty chart here. Sorry,
HML
F
SF.
Wait, that's F as in Frank or S as in Sam?
Sam Frank.
Okay, that's Toronto. No, it must be US.
I saw it there. If you back up before there you go. Just pick one.
Not IB. There it is. Okay, US. I don't see them in Canada or in the Canada side. So, I'll just look at this one.
Yeah.
No, I mean, honestly, like
Right.
This is the dog's breakfast, Craig.
Right. Are you calling the, yeah.
Yeah, so I don't even see, I mean, okay, is that maybe a rounding, but no, I think I can dismiss that one pretty quick. No.
It's a sector that has a lot of challenges ahead of it, and we'll see, but it's certainly not at a place that we would commit capital right now.
Yeah, I think you'd have to be smoking a lot of the product to like that chart. So with that in mind, we're going to get to the next question, which is by Vince. And yeah, by the way, when I read these, I'm saying he because Vince is a traditional man's name. I don't know if it's a he or she. Maybe there's a woman out there named Vince. I don't know. But anyways, Vince asks if I talk about the 3 and 3 rule. Could I elaborate? And so what I want to note is that the 3 and 3 rule, that's in my book Sideways, which by the way, I've just finished writing a revised edition. And today I actually have to do a final review of the manuscript. You're catching me as I record this. I am under the gun by the publisher to do that today before I go to bed. He wants it by midnight or I'm fired. So I'm going to have to do that. But one of the things I did revise a little bit is that 3 and 3 rule. So it's something that Craig and I, we're a work in progress, as everybody is in the trading world. So things move. And back when I wrote that rule, and that book was written in 2010, markets moved a little slower. They're moving pretty quickly now. So the 3% rule, it's the 3 days is our minimum. So Craig and I wait for 3 days minimum on a breakout or a breakdown, but we can wait up to 3 weeks. So that's been a bit of a revision for us. But the other side is the 3%. We don't wait for 3% specifically, where we become much more time orientated. In other words, it's nice to see the 3%, but 3% is a fairly good move. So what we do is we look for the minimum 3 days up to 3 weeks, and we if it's only 2%, we're still okay with that. It's nice to see the 3, but it's less hard and fast than the 3-day minimum is, which is absolute. Now I will quickly share screen because I wanted to just bring up a chart, and because part of the question is volume. So Vince asked about, well, where does volume fit into this? And the answer is, I'm not, this is traditional volume bars here. And this is a chart that we own. This is a stock we own. We own Nutrien, and we built a bit of a position. You can see a little breakout there. We bought. So this would be, count 3 days. We bought, and we recently added a little bit. Where we don't have. If you take the online technical course, you'll learn about like moving in legs, and we usually do 3 legs if we really like the stock. So we do 2% at a time. We've done 2 legs. You can see it's trying to build a base. It's making higher lows, higher highs, all that stuff that we like. This high is not higher than that. So there is still some question on the validity of the trade, but the volume has fallen. So you can say, well, that's not good, but it's really, I've become more of a believer in money flow than in straight out volume. Why? Because money flow is volume on up days times the percentage move up versus down days. So it tells you, is money actually moving into the stock on a net basis? And you can see that line says, yes, it is. And then this is a money flow index, which is basically just an RSI of this indicator. So I don't use traditional volume so much anymore, but I do use the 3-day rule. So breakout 3 days, boom, go in, put a second leg if it holds above that line, which it is, but we won't do a third leg until we see a breakout of this high and hopefully the 200-day moving average. So we're legging in a bit at a time. So hopefully that helps you, Vince. I'll stop sharing that. And this is one for both of us, and it's from Mark with a C, not a K. And can you share websites? So I can start off with a couple, and then Craig, if you have any to add, I'll let you have at it. We didn't actually discuss this question before the video, so I'm just going to give a couple of my own. So I like in fact, I read it myself every morning when I'm having my coffee and I'm half awake. Seeking Alpha has an email thing that they'll send to your inbox called What's Moving the Markets. And it comes to your inbox every single day, and it summarizes everything that's going on in like 3 paragraphs. So it's just the news, but it's good to know the news. They talk about, well, you know, the Fed's gonna speak at whatever time today, and the, you know, whatever's going on. Mara, like they talked about the comments coming out of, I think it was Tesla, stuff like that. That was today's news. So I use that for, you know, what's moving the markets, what stuff should we be paying attention to. And then another, like we buy institutional level research. So I'm not going to say, oh, you guys should all run out and buy the $10,000 packages a year that we buy. You're not going to do that. But the free stuff like Yahoo Finance. So that's another really good site. It's free and it covers a lot of stuff that you could use to, as you say in your question, keeping an eye on the market's pulse. So Craig, do you have any others that might be free to the retail user that you think of are worthy?
Well, I listen, they're the news outlets, whether it's Reuters or whether it's Bloomberg, they certainly give you pertinent information. The one consolidated kind of, and you know, unbiased website or blog is Frances' blog. She really in the blog is a view from abroad. I think it is called, and it's very concise. She's quite timely, and it's you know, it's a quick breakdown of what's happening in the market before in the morning. So it's one if you're looking for some free information.
Excellent. Yeah, and Frances Horostowski, longtime friend. She used to interview me all the time on BNN, and now she's running this blog site, View from Abroad. She says it just like that. She's got quite a sense of humor if you know her. And I interviewed her recently. So if you type her name, just type Frances, because spelling her last name is a challenge. So just type Frances in the video section on the Vitrend site, and you'll see the interview I did with her, and she's awesome. She's just so she, yeah, I forgot about that one. So thanks for that, Craig. Okay, Manny asks, will this market test the October 22nd lows of 3,600? I'll just quickly pull up a chart of the S&P. So my view is like everything comes down to, actually, you know what I'm going to do is I'm going to go to stock charts, because this is probably a better way of looking at it. So dollar SPX. Oops, I put $2 signs there. Okay, so this is the S&P 500. Some of you might have heard of that index, a little known index. So this is that first level. It's coming into that right now. It's up a tiny bit today, but it approached 42 yesterday. Intraday it hit 42.50. It's now 43.03 as I look on this screen. The 200-day comes in around 42.18 actually, and the support level, as you can see, which is former resistance, is same level around 4,200 resistance. It's where the 200-day comes in. It kind of bounced off of that yesterday because we hit 42.50 or so, and you can see there's a little bit of a kind of a spinning top there on the chart. Now, the question was, Mark was asking, is will it go to the old lows here? And the answer is not unless it penetrates this much stronger support level, which is 3,800. And I'm suggesting that 4,200 is pretty strong. So I have yet to see that cracked. If that cracks, I mean, then you've got the 200-day that's been cracked at the same time. So that's serious. So it will probably, if 4,200 cracks, it will probably hit 38. But that's to be seen. And, you know, Howard Marks likes to say, I often quote him, you don't predict, you do protect. Okay, you do prepare. And we're prepared for anything. Craig and I are holding about 27% cash in the equity platform, and I think it's about 30 in the aggressive platform. So we have lots of cash. We've got lots of stuff that's not so related to the S&P, and that's why we've been outperforming. I can't wait for our September numbers to come out. But whatever the case, the point is that I wouldn't even assume the October lows until we see this 4,200 and this 3,800 level cracked. So, you know, I won't make any kind of predictions because there's no point. We have to see one level at a time if they hold. When they break, then we can make the next prediction, which is down to the next level. And it's not even a prediction, it's just a probability. So, okay, next question is from Mandy. So the next couple of questions are mine, and then go back to Craig. So Manny asks, oh, sorry, that's the one we just did. Sorry, it was Manny that asked that question, not Mark. So the next question is from Paul, and Paul actually sent like posted two questions, and he answered his own question. So he asked, like, hey, when you do a stock chart on a high dividend stock, it distorts the chart for both the dividend and sometimes stock splits. But for those of you who don't know, I'm just going to do a quick stock charts thing. So Greg, we got this showing up? Yeah, there we go. Okay. So I'm going to go to a high dividend stock. Let's just pick BCE, because I know it's a high dividend stock, and we own this stock. It's not been fun to own it so far. But, as you can see, it is breaking down. We may have to sell the darn thing. We're forgiving that the market is pulling back, but we're probably going to end up selling the stock. But what's interesting here is that I want you to notice the difference. So you see the big swings and even this recent breakdown. Now what happens is if I put an underscore before the name, you see how I put an underscore there? We push update. Okay. So now we have a breakdown, but this is actually the breakdown's coming into an old level in 2020, the COVID lows. But the chart changed quite a bit once we did the underscore. It took out the dividends, because what happens is stock charts adds the dividends back in to price. It's a really weird situation. So my and stock splits are equally distorting of these charts. So the damage on BCE and a pure stock price, and this is one that we've been losing on, it has been greater than the chart without the underscore. In other words, when you include the dividend, which it adds back into price, which isn't correct, because people buy price, they don't buy dividends. So when we look at charts with a high dividend, now I'm not talking about something with a 1% dividend, because it really doesn't distort the chart that much. But when we look at high dividend charts, we always use the underscore to take that distortion out. And actually, if you look at Paul's email on the answers, Ask Me blog or Ask Us blog, he answered the question himself, but I just thought I'd point this out to people. Okay, so the next one is for Craig, and it's from Tamar. Take it away, Craig.
Still, Tamar asked about commercial real estate, and is it time for commercial real estate? I just want to start to say that all commercial real estate isn't the same. We would put a multifamily building in a different asset class kind of than an office building or an industrial building or a medical building. So it really depends on what type of commercial real estate you're referring to. Now, certainly the pressure on cap rates is having an impact on commercial real estate as a group. That is making them putting pressure on the value of those properties. It's costing more to finance them. To look at the group as a whole, the office properties are the ones that in an urban area are they are under pressure, but the multifamily apartments, they're doing okay, because we know that the rental rates have not come under pressure. If anything, inflation readings are telling us those are the areas that are actually increasing. So if you're going to look for an area, that's the area that is doing okay. Is there a time when office will turn around? I'd rather see it firm up before you'd guess it's kind of a falling knife maybe situation. at this point. You just, there's a lot of variables that we don't know yet, including the rates that you're going to have to finance them at. Now, speaking of rates, that goes into the next part of Tamara's question, is that, and I think others have asked on this as well, for the U.S. bonds and the treasuries, whether it's, you know, their appropriate recession protection, and well, the timing is what it comes down to. Do they? Yes, these longer term bonds should, when rates stop going down, and there's a strong sense that when rates stop going up, there's a strong sense that, you know, rates pausing, going down will be positive for the long-term bonds. But as we've seen, that could take a while. And so, is it a prediction of the recession? Well, we're in an environment where rates have risen faster than they've ever risen in history. So the result is, we don't know how long that is going to take to play out, and the impact, that the full impact of what those higher rates mean, and when, you know, and if. I think it's more a question of when the central bankers will have to ease off on their hawkish sentiment and lean into lower rates. I'll leave it there for now.
Okay, and actually the next one is for you as well, Craig. It's from Michael. Right.
And this is another where the question is asking on position size that we have in how we adjust the portfolio with different size positions. We suggest that if we really like a position, it's going to be a 7% weighting. Well, doing the math, 7% weighting across the board, you'd get 14 or so names. Well, the way we're allocating is that we really have to like the name, and it's not often that we are convinced across the board to have a 7% weighting in all positions. So it's the way we allocate is often with varying sizes of positions, depending on the characteristics, depending on our, you know, so many factors, whether we like the sector, whether we're comfortable with that position, whether we, you know, want to add to that position at some point. It's really about asset allocation, and we tend to have, on average, 25 positions in the portfolio. But that's an average, as you know. It's some days it's less, and some quarters it's more. So but suffice it to say, it's not often that we have ever convinced to be full weight in 14 positions. It doesn't happen.
Okay, and Craig, this one I asked you to answer because it was probably, Craig was a trader in his former life as well. So this I felt was more up Craig's alley than my own. Martin's question, if you have that in front of you, about
right. So
not so much
I never. Yeah,
Right.
Martin asked about gold and the trading of gold on the CME, which he looks for a quote on stock charts versus something you would find on Kitco. The difference being, you know, the stock chart is a futures, and that's CME. That's, you know, it's not backed by physical gold. It's futures contracts. So the, you know, and trading millions of contracts a day. The other side, Kitco, is an actual intermediary where you get a spot price for immediate delivery. So it's a pricing that has to do with the actual physical, whereas the CME does not to the same
Oh.
degree.
There you go. I just learned something new.
Yeah.
Okay, well, that's good. Thanks, Greg. So the next question is Paula. Paula's actually a very regular reader. Well, a lot of these people that I'm reading from, they're longtime readers. Paula's fairly active on the site. So she's got kind of two questions, and Craig's going to cover the first one, which we actually just pulled up NTR, so I don't need to talk about the chart. But it's to do with commodities in the Russia-Ukraine thing. So Craig, why don't you take that one away, and then I'll answer part two of her question.
So the Paul asked about the pressure or the influence that commodities had by the conflict in Russia-Ukraine. Certainly part of that is, and you could see it on the chart of the NTR we're looking at, and the others others in the agricultural space are very similar. That when in beginning of 22, when the conflict really came to your media outlets, the price went straight up, parabolic. It's come back, and but going forward, anytime there's conflict, there's going to be constraint on the supply of those commodities. Specifically, you look at uranium. Uranium is very concentrated in this area of the world. So when it's locked in, it's going to put pressure on the commodity itself. So yes, and besides the fact that we think that the commodity is for other reasons as well an area that you want to have some allocation of capital to, the conflict in Russia-Ukraine continues to put pressure on the commodity index. It's the commodities themselves. We see it in energy, we see it in uranium, as I mentioned, and yes, we see it in agriculture as well. So there is likely to continue to be a place for commodities in your portfolio, with this as being one of the elements that you are protecting yourself against.
Okay, so I can just very quickly answer the second part of Paula's question. And she recognizes, she's asking about the difference between weekly and daily charts and where I would use them. So she recognizes that obviously weekly will give you a different time frame. I mean, you can squish daily data into just as long a time frame, but you're really the indicators such as price momentum indicators, and even MFI. I was just talking about money flow type of momentum indicators, and all those different views on a chart drastically change when it comes to daily versus weekly. So what I tend to do is I use the daily, like you said, Paula, you even sort of answered that, to establish the trend. I want to know support, resistance, and trend, and all that kind of thing, because it's a big picture question. But if we were to look at a daily chart, then we can get a closer look at those indicators. And maybe I will pull up an example. If I pulled up, well, I'm going to go back to nutrient because she was asking about that. So this is the nutrient chart, and I'm going to go back to the daily, weekly, and you can see the trend, bit of a base building. You can see stochastics looks overbought and rounding over, but you can see MACD is moving up. Okay, so RSI is neutral. All right, so if we go to the daily chart, then we have a different picture. We have stochastics is actually oversold. Like, in other words, it looks like nutrient may start moving up in the very near term, RSI is, if anything, a little bit bearish, and MACD is a little bit bearish on the daily chart, but not on the weekly charts. Remember, on the weekly charts, it was bullish. So what this is telling us is that in the near term, because on the daily chart, the most important indicator is the near-term indicator, it's the stochastics. So that little trend line, there's a good chance that Nutrien might bounce off of it sooner or later, like within the next week or 2 weeks or so. But if we go to the weekly chart, then it's not necessarily saying that's that stochastics is showing near-term upside, but the other two indicators on the long term are. So that's one way I look at it, is I'm looking at sort of the big picture with the weekly chart for both the trend and the indicators. But the other thing I'm going to just quickly bring up while we're on the subject is candlesticks. So you can get a better picture of the turning points when you use candlesticks on a daily chart, because it gives you that intraday stuff. So you had just one example here. You can see an inverted hammer, and that told us that the market was likely nearing a top, and it was. In fact, it's just a daily chart top, so it was a short-term move down. Okay, so I like them for different reasons, but really what it comes down to is near-term view versus longer-term view. All right, so that answers Paula's questions. The next question, either one of us can answer, but I'll get Craig to answer it. It's on stop loss orders. So Craig, why don't you address that?
Sure. Yeah. So the stop loss order is, just to refresh, you want to sell at that level when a trade occurs. That becomes a market order. So you put your order in to sell at a certain level. When that level gets hit, your order becomes a market order to sell. But what the order book looks like at that time, you don't know ahead of time. So, before your order becomes a market order, there are already market orders in there at the time. So the question that Sheldon asks is, why doesn't it happen immediately? Well, it doesn't happen immediately because there's other orders in there prior to your order becoming a market order. Okay, it's that straightforward.
Okay, and I will just add that we don't use physical stop orders, and the reason is because, and Craig and I were talking about how we explain this on the video, but basically, let's just artificial dollar amount. You don't want it to drop below $10, so you put a stop at $9.99. And then, so it goes to $9.99. There was a few bids there. So yeah, you got some fills, but you didn't get your entire order filled. And maybe even the stock moves up again right after that. And you just got rid of some stocks right at the bottom, and off it goes, to the top. So that is why, going back to somebody was asking about the 3 and 3 rule earlier, we answered that. That's why I invented the 3 and 3 rule. Okay, that we wait a minimum of 3 days, because we're not day traders, so we're not interested in intraday moves, and we want to see if the move is real. So we don't use stop orders for the reason that we don't want to get stopped out and then watch us, get our heads handed to us on a platter. So we give it a minimum of 3 days if something goes below the support level that we are watching. And we often, depending on the volatility of the stock, we often give it more. Like we'll give it up to 3 weeks. And that applies to breakouts as well. We don't want to get head faked. A stock breaks out, it fools you. It looks like, yay, it's a new high. It's just broken through all that resistance. And then lo and behold, the thing drops like 2 days later. So, and I'm sure people watching this video have never had that happen to them. It's only to us, tongue in cheek, because it happens to everybody. And so the rules that I created on the technical side have to do with at least improving your odds of not getting whipsawed on some of these trades. Okay, so the next question is from Mark. Craig, you can take that one.
Okay, Mark asks again about the yields on the 10-year. and its predictability of a recession and how that can protect, in a recession or in recession, how that can protect your portfolio. I think we answered that. He also asked about hedging and, the Canadian versus the US dollar. As with the, the yields, it depends on your timeline and your expectation of what, when you're going to need the protection. The Canadian US dollar has been in a pretty tight range over the last year plus. So that, Keith, if you want to pull up a chart of the Canada US dollar, to say that you want to hedge, you're hedging against an event that hasn't shown signs of transpiring yet, or coming to fruition. So it's protection, yes, against an event that could someday impact you. Yes, if you need, where are you looking for Canadian dollars? Well, then invest in the Canadian equivalent. Perhaps you'd be just as well served, because the US Canada rates themselves, the longer end, are behaving quite similar at this point. So to hedge the dollar exposure, it might be a moot point.
Okay, so I mean, if you want me to comment technically, this is a chart. If I assume a lot of the viewers of this video are longtime readers of the blog. I've been blogging since this blog since 2009, I think, in various forms. So it's been around a little bit of time, and so this is one of those charts that I posted like probably way back in 2009 or 2010, and I just keep adding to it. I just draw my lines. But what's amazing about this chart is that the very lines that I just, like this blue line that I drew, way back when, it's held true ever since. And when the downtrend started here, it's held true. And same with these levels, 83 and 73. So these levels are offer an awful lot of predictability. And what you'll notice is that, right now, like you can see, there've been many, some people will call them down flags or whatever, but there's been never many sort of mini bear markets in the Canadian dollar on a relative basis to the US dollar. It just means the US dollar may be strengthening. It doesn't mean the Canadian dollar is weakening against world currencies, but so, because it's a measurement against the US dollar specifically. But that's how we tend to look at it. And we're just in one of those. And the funny thing is, though, that when the market gets down around 72, which it recently did, like earlier this year, and in fact, late 22, you can see it basically hit 72 and spiked a little bit below, but I like to say the word ish, 72-ish. So it's been consolidating since then. So, more than likely this downtrend may come to an end soon, and then you'll see the dollar go up, the Canadian dollar, that is, go up. Why? Well, one reason could be the fact that, oil and other such commodities, which, as you know, Craig and I are quite bullish on, are looking pretty good right now. And yeah, we need oil to break out. It needs to do that, and you saw the resistance, but it's getting there, and there's a good fundamental reason for oil breaking out, because the world isn't going to switch over to so-called green energy by 2025, no matter what your local politician seems to fantasize about. So there is a need for oil. It's actually only growing. Kevin O'Leary just put out a video the other day, and he's just is buying and building a multi-billion-dollar refinery project in the US. Why? Because he sees massive need for oil. Mr. Wonderful himself likes it. So I don't know. I gotta like it, I think. And the chart tells me that if we see the breakout, it'll be powerful. So, that's going to push the Canadian dollar higher, because it should be a major export of ours, so long as we get a sensible government. Now that's another question, but anyways, the final question is my favorite, and it's a question from me, and it's from Greg. And Greg, I actually left your reply unlike the rest of these questions where we're just answering on the video, I left you a reply on the Ask Me Anything blog because there's a few points I wanted to cover, but I'll just briefly cover them now. Like, so his question is, with fixed income, short-term money, like high interest savings accounts and T-bills and whatever, paying 5% plus, why bother at the, as he said, the old Wall Street casino? Well, I'm going to say that, I just finished writing or rewriting my book Sideways, which was my bestseller. So it needed a rewrite, seeing as I published it in 11 and it was written in 2010. But a part of the book, I start off in the introduction arguing for the potential of another era of sideways markets. That's what the original book was written about, is all the sideways markets that the markets have done since the late 1800s. And I think there's a good, Craig and I wrote a research report a while back on the potential for this happening, that the market could move sideways for 5 to 10 years. And so I guess we'll see, but so far we're having a trouble getting back to those old highs of 2021. So far, it kind of looks like the thesis which Craig and I wrote about in 21 is correct. So if the market is sideways and you can get 5%, then why would you buy stocks is the question. And the answer is because you can make an awful lot of money in a sideways market. I mean, these sideways markets, they swing. Look what's happened this year. Like 22 fell 25%. So far in 23, it's been up, almost half of that again, like 15% if you look at the S&P 500. Now it's retracing some of that now, but it's a swing trader's dream. Okay. And guess what? You're right in one way, Greg. So the average investor who goes to their online account or goes to their local bank and buys an index ETF or an index mutual fund or just a regular mutual fund that is $1 billion fund that can't trade, they're not gonna make a lot of money in this market. I mean, they're gonna make 20% up 1 year and 20% down the next, if I'm right. So you're right. That person ought to buy the 5% bond and forget about it. But could you make more than that in a swing trading market? Damn straight. You can make a lot of money in a swing trading market. And so case in point, last year in 22, even though the market fell, Craig and I actually made about 1% on the equity platform. So, and that was in a bear market. Now, when we've been holding cash for this sell-off, why? Because we think there's tons of opportunity when the sell-off ends and we can go in. That's swing trading. Okay. Second thing is, we can't, things rotate. So if we look at what's happening now, yeah, a lot of the growth stocks are under pressure. Why? Because rates are high, inflation and all that stuff. That's a rotation that we are seeing. And what's happened to oil lately? What's even starting to happen in the metals lately is that we're seeing rotation into hard assets again. We saw this, by the way, after COVID. Hard assets crashed and then they climbed like crazy after that. And Craig and I played that trade. So what we're saying is that, yeah, okay, a buy and hold investor that buys an index ETF, in our opinion, is not going to have a good time in the next little while. And they should buy a 5% GIC because they'll make probably better money. But for someone with a plan, you get the tax benefits of capital gains and you can make a lot of money in a swing trading market. And you can go into other assets that are not the stock market. You can buy oil, for example, if it breaks out. You can buy gold, for example. All these different things that I'm not saying we should buy these things today. What I am saying is there's tons of alternatives that are not what worked yesterday. You got to think ahead. Craig, do you have any comments on that as well? Because I've just ranted.
No, that's exactly our thesis. That's exactly where we stand and why we think as an active portfolio manager, you've got an advantage, and it's not a passive market any longer.
Yeah. So and Greg, to finish up, I noted in the comment, and I do want you to read it on the Ask Me questions. I said any idiot can make money in a bull market, and lots of idiots did. Okay. Look at real estate the past 3 years. Any idiot could make, now the idiots aren't making so much money in real estate. Same with the market. Okay. But I like to think that Craig and I are idiots. So we have a strategy, and if you follow the work that I presented in the technical course, you have a strategy. hopefully you're not an idiot. And if you're not, you can make money in this market, because it's the people that think that, you know, doing, what is the old saying goes, you try to get different results doing the same old thing. That's the definition of insanity. So absolutely, like, you have to change your tune, but it doesn't mean you can't make money, and it doesn't mean you can't make a heck of a lot more than just 5%. That's, by the way, fully taxed, you know, in this kind of market. So we'll end with that, and we'll just say thank you very much for watching. This was a long video, but we covered all of your questions, and we'll do another one soon.
Thanks. See you next time.
Bye-bye.